Welcome to This Explainer. We are living in a truly wild moment right now, aren't we? The headline economic numbers look absolutely magnificent on the surface, but if you look just a little bit deeper, the foundations are telling us a completely different story. So today, we're going to peel back the layers of our current financial landscape and see what's actually holding the whole thing up.
Here's our quick game plan for today. We're starting with the AI earnings illusion. Then we'll move into vendor financing the bubble, looking at bailing out the bond market, examining the Fed's communication problem, and finally, we'll uncover the P-shaped economy. Let's jump right in. Section 1, the AI earnings illusion. We're going to unpack the hidden drivers of this massive 2026 tech boom. 85 times forward earnings. Just let that sink in for a second. Companies like Palantir are trading at multiples that are, well, completely parabolic. Historically, averages sit way, way lower than this, but investors are so incredibly eager to capture the AI explosion that they are literally throwing historical valuations out the window. It feels entirely unstoppable right now. But there is a massive distortion hiding in the data here. Experts call it the anthropic effect, and it is absolutely warping our view of corporate profits. On paper, S&P 500 Q2 earnings growth looks like a staggering 48%. Incredible, right? Well, actually, when you strip out the non-operating paper gains from mega-cap tech companies investing in private AI startups, that earnings growth plummets to 29%. This illusion is being driven by private startups like Anthropic, which rocketed to a $965 billion valuation in May of 2026, almost $1 trillion for a company that was pre-revenue just 2 years ago. Since giants like Google and Amazon hold huge stakes in these private AI labs, their own corporate earnings reports look like they're exploding, but it's largely just paper gains from these sky-high valuations. We're essentially looking at a massive earnings bubble. To really grasp the sheer scale and honestly, the desperation of this capital expenditure bubble, just listen to this quote from Alphabet co-founder Larry Page. He said he'd rather see Alphabet go bankrupt than lose the AI war. That is intense. Tech giants are pouring hundreds of billions into infrastructure driven by the absolute terror of being left behind. It's not just business anymore, it's an existential race. Which brings us to Section 2. Vendor financing the bubble. Let's look at the historical precedents for this AI spending spree. History doesn't repeat itself, but it definitely rhymes. When you're building a totally new economy and traditional bank lending isn't there, the supply chain just finances itself. We saw it with the 1840s railroads, the post-WWI rebuild, and the 90s internet boom. Today, mega-cap tech companies are cross-owning and financing each other to build out AI data centers. Basically, the vendors own the suppliers who own the customers. It's a closed-loop system entirely fueling its own fire. But here's the catch. With all this concentrated capital continuously straining the broader financial system, we have to ask a really vital question. Who is managing the macroeconomic backdrop? How is the government keeping this party going without the whole system breaking down? Let's find out in Section 3, Bailing Out the Bond Market. We're diving into the subsurface plumbing of the U.S. Treasury. According to some brilliant analysis from 42 Macro, Treasury Secretary Scott Bessent is actively bailing out the bond market right now. How? By shifting to a highly dovish net financing policy. They weighted borrowing heavily towards shorter-term debt, 61% in Q3 and 58% in Q4. In plain English, they're stepping in to artificially restrict the supply of long-term bonds so they don't overwhelm the market. It's a stealthy form of financial repression designed to back off the bond vigilantes and give the Fed some desperately needed breathing room. And why are they forced to do this? Because foreign capital is actively pulling away, running away, really, from U.S. debt to fund their own domestic priorities. Japan wants their capital home for reflation, Europe is busy remilitarizing, China is strategically decoupling, and the global south is actively distancing itself from the US dollar. All of this creates a massive geopolitical supply-demand imbalance that aggressively drains demand for US treasuries. You put that into perspective, Japanese government bond yields just hit a 30-year high. Japanese investors are now heavily incentivized to yank their money out of the US. So, to prevent a catastrophic dumping of U.S. treasuries, the Treasury effectively asked the Fed to expand repo facilities. They are bending over backwards to let Japan access dollars safely. It's a massive, coordinated, behind-the-scenes effort to keep the global bond market from collapsing. Moving into Section 4, the Fed's communication problem, navigating policy in a high-stakes environment. So under Fed Chair Kevin Warsh, we are officially seeing the end of the radical transparency era.
He is deliberately leaving markets guessing about the Fed's true reaction function. Instead of telegraphing every move, he's pushing critical policy decisions strictly behind closed doors, into 5 internal task forces. The market is seriously struggling right now because that clear, spoon-fed guidance we all got so used to, it's completely gone.
The reality is, the Fed is trapped in a brutal dilemma. We've got a hot nominal economy with a high neutral rate, which forces tighter short-term policy so they don't lose their inflation-fighting credibility. But on the flip side, they're secretly preparing for structural long-term easing to manage our massive government debt. Analysts are calling it a play-action-pass. They have to act tough today to set up the easing they desperately need tomorrow, all while dodging the intense political pressure of the looming 2026 midterm elections.
Which brings us to our final part, Section 5, the P-shaped economy. This is the foundational reality for the everyday consumer.
Treasury Secretary Scott Bessent recently said he's sick of hearing about the K-shaped economy. But look, brushing the conversation under the rug doesn't change the actual facts on the ground. When we look past the soaring stock market, the data reveals a starkly different, deeply painful reality for the bottom tier of earners who are completely shut out of this asset boom.
Just look at how drastically uneven real wage growth has become. For the top quartile of workers, wage growth is holding steady at 1.5%. Not bad. But for the bottom 25%, it has plummeted to a mere 0.8%. The gap between the top and the bottom isn't just sitting there. It is rapidly, actively widening.
Because of this massive split, experts are tossing out the K-shape entirely. Now, they're calling it a P-shaped economy. Picture the letter P. That upper loop, that's the top 10% of households holding almost all the wealth, getting richer off booming AI stocks and high yields. And that descending stem going straight down, that's the vast majority of the population struggling with sticky inflation, drowning in debt, and holding zero significant assets to cushion the blow.
It creates this incredibly awkward dichotomy in our society. On one hand, you have this booming macro economy with record-breaking corporate profits and a stock market that feels literally invincible. But on the exact same day, survey data shows everyday consumers have depleted their savings, are getting crushed by variable rate debt, and in some cases are actually skipping meals just to make ends meet. The labor market is simply being left behind. So what is the ultimate takeaway from this explainer? It's that these record highs in tech aren't happening in a vacuum. They are intrinsically tied to complex government plumbing that aggressively protects capital and financial markets, but ultimately squeezes the working class. It's a carefully engineered system that works wonders if you own assets, but it's totally disconnected from Main Street.
Which leaves us with one final, provocative question to think about. If the stock market continues to aggressively separate from the daily reality of the average consumer, how long can this delicate balancing act truly last before the entire system snaps? Thank you so much for joining me for this explainer today. I really hope it helped illuminate the deeper forces at play in our economy right now.